Welcome, everybody, and welcome to the inaugural episode of the MPA Frankly Speaking webinar series. My name's Brent Walker. I'm a co-founder of Morrison Park Advisors. We are one of Canada's leading investment banking firms focused on the growing alternative investment market in Canada. I'd like to thank all of our clients and guests and friends that have joined with us today to share some of this content with us. We're really excited. We've got an amazing lineup of speakers and topics that we think are really going to be of interest to our clients in this growing alternative investment market that we're focusing on and seeing. For our first episode, I'm really delighted to welcome Talbot Babineau. Talbot is the CEO of IBV Capital. IBV Capital is a really interesting platform, alternative asset management firm that has one of the most interesting and compelling investment strategies that we've seen in the marketplace so far. We're really excited to talk to Talbot today about one particular investment that we worked with him on and that we think is emblematic of the types of investment opportunities that are available in the alternative investment space. Welcome, Talbot. How are you doing?
I'm great. Brent, thank you so much for having me. I'm honored to be the first of many amazing guests that you'll be having on the Frankly Speaking series. It's going to be an exciting series, and I'm looking forward to the future episodes. For those that may be unfamiliar with our story, my name is Talbot Babineau. I'm the CEO of IBV Capital. IBV Capital evolved out of a family office, and through our fund, we manage a pool of go anywhere capital. And we're agnostic to industry and geography. We also tactically move around the capital structure. And this is all with the goal of finding 10 to 20 of the best investments that we can source. And by virtue of this flexible strategy, we've identified some pretty unique opportunities and played a really active role in creating value within them. Brent, it was your firm's expertise in the infrastructure space that brought us together to work on Ascendant Group, which is the investment we're going to be speaking about today, and arguably it's one of my firm's most complicated investments that we've been involved in. But if you can believe it or not, it was 2014 that you and I first met. So
was it really? Wow.
Yeah. My time flies when you're having fun, right?
Yes, absolutely. And I think Ascendant was really the first opportunity we had to work together, and we've done lots of interesting things since. Maybe just spend a couple of minutes, Talbot, talking about Ascendant, the company. Obviously this is a utility in the Caribbean, but maybe you can just give people a bit of a high-level overview about the company and the nature of your investment.
Yeah, absolutely. So Ascendant Group was a conglomerate that was traded on the Bermuda Stock Exchange. And within that conglomerate, it had a few different companies, but the crown jewel was Bermuda Electric Light Company, BELCO, which was Bermuda's sole integrated electric utility. And the company was founded in 1907, so it was about 108 years old before we became first involved. And obviously, it had its way of operating, but it was around a $50 million company, had about $9 million of cash and no debt on its balance sheet, which was quite unusual for an electric utility, and but it had a tremendous amount of cash flow, and we saw it as being a really attractive opportunity, and we got involved at what was an incredibly attractive price, around $5 a share, and we just exited at $36 a share just late last year. When we sold it to Algonquin Power. So took it, $50 million market cap to a $360 million market cap in a few short years. So just a tremendous lift and 50% IRR.
Yeah, I mean, 50% IRR or a 7x multiple on investment. I think even private equity firms would tell you that they would have trouble generating those types of returns in the businesses that normally suit the private equity world. what I've always found so interesting about this story, Talbot, is that you're able to do this in the utility sector. And we've done a lot of work advising clients in the utility sector, and we've done lots of work valuing utilities. And I think any utility investor would tell you that their expectations are that they're going to earn like a mid or high single digit return on equity, and the very good utility managers can maybe improve by 100 or 200 basis points, but to get to 50% IRR, well in excess of utility returns, or well in excess even of normal private equity returns, is really quite remarkable. So I think what I'd like to really get you to tell us more about was how you uncovered and saw that value proposition, and what were some of the core elements of the value proposition and the strategy you went about to unlock it.
Yeah, absolutely. So I think it all starts with sourcing, and because of our flexible mandate, we can go into jurisdictions that are a little bit more unconventional in nature.
Right.
I mean, I don't think too many people look in Bermuda for interesting and attractive opportunities. So it really kind of starts there. But as we get to the specifics of this investment, really it was our ability to identify a few different levers that the company could pull to improve its financial and operational underpinning that would eventually create a tremendous amount of value that we could then use an alternative strategy and unlock that value in a few different ways. And the three key elements that we saw was there was opportunity to become far more operationally efficient. Then there was an opportunity to optimize the balance sheet, and really an electric utility with almost no long-term debt on its balance sheet is quite unusual. And then the third was a regulatory compact that we wanted to further develop. So when we first identified the company, it was in a regulatory environment that was in its infancy, but we recognized that it was going to transfer from being a nascent regulatory environment into something far more mature and sophisticated, and something that we would see in North America, which would broaden out the appeal of the company upon exit to financial and strategic buyers. So it was really in those different verticals that we looked for unlocking value.
And it seems to me, Talbot, that putting those three together was really important, because in a normal utility environment that we would be used to in Canada or the United States, you would normally expect that if there were efficiencies or opportunities that the utility had in front of them to improve their operations under a normal regulatory environment, those typically get passed on to the consumers rather than to the shareholders. And that's the way it works in a normal regulatory environment. So maybe just explain to us how you saw the regulatory environment, and whether that provided you an opportunity to get some of those returns from a shareholder point of view versus a consumer point of view. And then why was the regulatory environment, making it more normalized like we were used to in Canada, why was that important?
Yeah, so really this was a couple steps to this. First of all, the regulatory environment, and this was a little bit of a function of the jurisdiction, really wasn't in place. But what we recognized, and this is somewhat counterintuitive, is that regulation and transferring to a sophisticated regulatory environment was going to be to the companies and ultimately the shareholders' benefit. And the reason being was, by creating a sophisticated environment, it was going to effectively lock in the profitability of the electric utility for the foreseeable future. And that was really important, because then it becomes an annuity with tremendous cash flow potential, which is something that's quite attractive in the marketplace. And then when you think about just the improvement from an economic standpoint, and then translating that to the overall individuals that would maybe want to purchase this company, and shareholders, and the new regulatory environment was going to give them peace of mind that it was going to be stable for the foreseeable future, and that it was going to be less integrated with the political whims of the island. So that was really important, is kind of checking off those two boxes there.
So the ultimate buyer of the company, and we'll come to this maybe a little later, but it was Algonquin, correct?
Yeah, that's correct.
And I mean, Algonquin is a very well known and very well respected utility. So I think part of the strategy here was to create a regulatory environment that the Algonquins of the world and others would be used to dealing with and used to operating and sort of get the synergies of their business strategy. So it sounds like a big part of the value unlock strategy was really to make this a less mature asset and into a more mature asset, and sort of ride that ride that benefit and get the value benefit from doing that. But still, I mean, so there's obviously some risk that you were taking there, but I think the risk adjusted returns were still really, really attractive. So I think one of the other things that we've talked about, Talbot, is one of the sources of value creation here was sort of the lack of liquidity of this asset. This is a company that was traded on the Bermuda Stock Exchange. The shares would trade a few times a month. So how did you go about building your position, and how did you look at liquidity for an investment like this? I mean, it's not like in a normal private equity environment, a company comes up for sale and you make a bid to buy it, but this had a bit of a publicly traded feel to it. So maybe just talk about how you built up your position and built up the investment in that illiquid situation.
Yeah, so we treated this as a private investment, or quasi-private, based on the level of liquidity that was involved, and it was incredibly hard to transact in shares of this company. We had to, as an organization, IBV Capital, recreate our back office just to begin to buy shares in this company as a result of the way the Bermuda Stock Exchange technically operates. We got into the actual piping of things. And we tried to buy parts of the company in kind of three different ways. One was just buying shares that were becoming available on the Bermuda Stock Exchange. And interesting little story. We actually got a hold of the shareholder registry very, very early on, and use that registry to cold call investors to try to suss out shares that we could purchase. And a couple shares came out of that, but more importantly, we were actually able to identify some really large shareholders in the process that would become very valuable later on. Second, as we were building our position in that way, the second way we tried to acquire shares is through really large blocks from individuals that were looking for liquidity. The liquidity premium that we were getting was going to be incredible, and we had the capability of holding this investment for an exceptionally long period of time, and we're using that to our advantage. And then, quite frankly, the third way we were trying to gain exposure to Ascendant Group, because of how attractive we thought that this particular investment was, is we tried to buy the entire company. And we'll give management credit; they understood that there was considerable value here, and despite an enormous premium that we offered for all the shares, they unfortunately declined it. But again, we can't fault them for that. They clearly understood there was a lot of value there.
Right, but you were able to amass a relatively significant position in the company, correct?
Yeah, we ended up being the largest independent shareholder of the company over a period of 5 years. We represent about 90% of the trading volume of the shares over a 5-year period.
But you had a minority interest, correct?
That's correct, yeah.
So it's interesting. So you saw a huge value unlock strategy. You had liquidity issues going in. You're obviously going to have liquidity issues going out. So there was a big job here to pull on all those value levers and get to an exit. And you'd mentioned that this was a 108-year-old company. and it's a utility servicing the size of Peterborough. So how do you go about influencing a company that is in that situation? They're 108 years old, very conservative. You don't have a controlling position. So how did you go about sort of following through on this unique, what seemed to be a unique strategy that they had not fully appreciated?
Well, I think a lot of it came down to the merit of the idea. But what I'll do is I'll kind of take a step back and talk about just the overall environment when it comes to kind of activism in its conventional sense. That's kind of a model that's intrinsically broken, and we recognize that. And the reason why that model is broken is because it creates very binary outcomes, whereby if management wins, the investor loses and has to walk away, or conversely, the investor wins and management and the board end up losing and they have to walk away. So
Right.
everybody is kind of fighting or transacting based on that kind of fear. Which I don't
So
think
it's a win-lose. You're saying the conventional activist operates in a win-lose type of environment. If I win, I get control of the board. If I don't get control of the board, I lose, and it's treated like a zero-sum game almost.
Absolutely, we recognized that in this exact instance and others that you cannot operate in that fashion, especially as somebody foreign going into a jurisdiction like Bermuda. Coming in with that approach is not going to garner much favor for you. So what we spent a tremendous amount of time doing is identifying not just what would fit into the strategies that we thought would create value, but also recognizing the constraints that the management team and the board were going to face if they started to execute on any strategy. And by doing that, we could reverse engineer a path to a regulatory strategy, an operations strategy, and a finance strategy, and even the value unlock plan, so that they could actually effectively execute on it. So by doing that, when we met, we put that plan in place, and we met with the management team, we met with the board, we shared our thoughts on what they could do, we shared our thoughts on the constraints that we thought they were going to face, and where some things were going to be problematic versus smooth for other components of the strategy. Once they recognized that we were really encouraged by their overall capability to execute on this plan, they very quickly transitioned to the old way of what they were doing to this kind of new level of efficiency that they could operate with. So it was an outsider coming in with a brand new perspective, but also recognizing, some of the hurdles that they were going to face, and making this a win-win-win for, I think it had to be a win for the customers. It had to be a win for the employees. It had to be a win for the people of Bermuda, and the strategy had to be a win for the government of Bermuda. And I think we checked all those boxes.
I mean, just listening to the way you described this, Talbot, again, it just goes to the points I was trying to make in my introductory remarks, which is these are not conventional things that you normally see money managers do. You went down to the island, you met with the board and management, but you didn't meet with them to ask them a question because you're trying to build your model. You were actually coming forward with a lot of value-added ideas. You actually made an attempt to buy the company. You spent time with other stakeholders on the island. I know you were very active down there with regulators and with government. So you're using a whole portfolio of sort of private capital strategies to sort of generate this investment. And I think that obviously the last stage of that process was facilitating the sale to Algonquin. Now you were not on the board, so you were not sort of right on the inside. But what steps did you take to sort of help facilitate the sale to Algonquin?
Yes, so not being on the board actually worked out incredibly well in our favor, and that's because we were no longer restricted in what we could do, and we became involved in the exit in a few different ways. First of all, when it was announced that the company was conducting a strategic review and going to proceed with a sale process, the shares of the company were trading around $15, and the book value of the company was around $30. So first and foremost, what we recognize is that it was going to be incredibly hard for a buyer to pay a premium of that magnitude and be able to take that back to their board or their investment committee. So we were tremendously concerned about this just being undervalued by a buyer. So where we got involved was was becoming quite public about our involvement in the company, which I think came as somewhat of a surprise to the island that, after 4 or 5 years, we came out and became public that we had such a large stake in the organization, and nobody had known about it up to that point.
Sorry, when you say nobody knew about it, you mean like maybe the general public or other smaller shareholders?
Yeah, the general public had almost no knowledge of us being involved to the degree that we were involved. So we were able to come out and very strategically, in terms of our timing and our communication, we communicated to shareholders, and then we also communicated to the general public that we thought that this company had a tremendous amount of value, that it should trade for a premium above book, which was $30 at the time. And if we didn't get an offer that expressed our firm views of value, that there were other mechanisms that could be used to unlock value, such as relisting on the Toronto Stock Exchange. And that was a discussion we had with management. So I think we facilitated, and it became apparent after the fact, we facilitated a much higher premium for the company. And then the second way we became involved is when a transaction of this nature happens, and it's so strategic to the country, naturally many stakeholders get involved in the approval process. And we stepped in and really were working quite closely with those stakeholders to show them the benefits of what would happen if Algonquin were to purchase.
Well, and I think it's safe to say that your position was large enough that if you were not interested in selling, it would have made it much more difficult for Algonquin to actually acquire the company. So I think that the position that you'd built also helped from that point of view. And obviously it succeeded, because you said that it was worth at least book, which was $30, and you actually got a price of $36, if I recall, correct?
Yes. Yeah.
So, I mean, the other noteworthy thing, of course, is that transaction actually closed in the midst of COVID, and even though it was priced in advance of COVID. I guess the obvious question here, Talbot, is this just a flash in the pan? Is this, did you luck out here, or is this a scalable strategy? Do you see more ascendants out there, and are you able to sort of execute on this in a much more significant way going forward?
Yeah, absolutely. So kind of more broadly, we see a tremendous amount of opportunity in both conventional and unconventional jurisdictions. When I think about how we operate and the very broad toolbox that we have at our disposal, I think it's quite natural for us to be able to go out, source opportunities of this caliber, and execute on them in a very targeted way. And I think we can do that within the Caribbean region and Bermuda itself. And I think in that region today, as a result of COVID, you're seeing some remarkable impacts that are happening in assets that would be considered critical in nature and infrastructure that have never been stressed to the level
Right.
that they're currently being stressed. So if you think about it, we're currently in high season for most Caribbean countries, and at the moment they have no tourism, and the governments and different organizations down there are really kind of starved for capital at the moment. And we fit well into areas where there's a big difference or a big gap between the supply and the demand of capital. So I think certainly in that jurisdiction, yes. And then if I think more broadly, even about our strategy, which traverses conventional jurisdictions as well, we have demonstrated capabilities that kind of cover three key characteristics that we usually find within investments. One are carve-out opportunities. And if you could remember with Ascendant, there were different businesses that would be carved out. A tremendous number of opportunities in misunderstood geographies, misunderstood industries. And usually this is just a result of complexity that we can go in and sift our way through and really organize ourselves. And then lastly, we can be quite opportunistic, as we proved in Ascendant Group, finding opportunities.
Well, Talbot, we could probably talk for another hour about, having a flexible pool of capital and how you can take, how taking advantage of sort of these volatile environment that we're in, creates some really interesting opportunities. And it sounds like you've got quite a pipeline of opportunities. Maybe we'll see another Ascendant soon in your future. So I'd really like to thank you for spending this time with us, and I hope you're going to come back, because it feels like there's a lot more that we could talk about here about pursuing this very unconventional strategy. It's it's very much right in the middle of the alternative investment space. So it's just fascinating, and again, we can talk about it more. So I hope you're going to come back. Okay.
Absolutely. Thank you so much for having me, and I look forward to it.
Well, and I'd like to thank again. I'd like to thank all of our friends and our clients and guests that are participating on the webinar today. Again, we hope to have a number of very compelling speakers and opportunities going forward. We're going to try to do this on probably about a monthly basis. Our next installment will be my partner Dave Santangeli in about the first week of March, and he'll be talking about social impact investing. And I guess the final thing would be that if any of our participants do have questions about what we've talked about today, or want to explore any of it further, because there's a lot more we could say, you can certainly follow us on LinkedIn and reach out to us on LinkedIn or by email, and we'll certainly follow up with you directly. So thank you very much, and I hope everybody has a great rest of the day.